Hey everyone, welcome back to the channel. Today we are stepping away from lower time frame execution to address the macro framework of long-term account scaling. The number one reason 99% of retail traders fail to compound their capital is because they are entirely trapped in micro level thinking. They hover over lower time frames, obsessing over every single minor fluctuation out of pure anxiety. Rule number one for scaling your capital is removing the micro noise. When you constantly look at your screen 24/7, seeking immediate reassurance from every single tick, you completely destroy your edge. You choke your long-term growth because you are reacting temporary volatility. Professional compounding requires you to lock in your macro parameters, step back completely, and let the data compile over time. Without your emotional intervention, you have to be completely comfortable with space and let the market do its time take. This brings us to rule number one, mastering and respecting the drawdown phase. Every successful mechanical system, whether it is trading algorithm or a personal routine, must go through periods of contraction and absolute silence. Amateur traders panic when a position sits in the negative or when nothing is happening for days because they lack emotional maturity. They try to force immediate outcomes and send fanatic orders or break their own rules just to feel a sense of control. But trying to force a market to move on your personal fanatic timeline never works. It only destroys your capital and your discipline. True maturity means having the detachment to respect the silence of a drawdown. You accept the boundary of your plan, you leave the screen alone, and you allow the strategy space to stabilize. Strength isn't shown when things are expanding, it is proven by your self control when things are completely quiet. Okay, so let's talk about this trade that I took on the 4 hour. We are talking about the bigger time frame because it is more important to understand that the bigger time frame is your friend than having a smaller time frame which is controlled by the bigger time frame. If you are a scalper that trades on the 1 minute, it is more of a headache to have a trade in 1 minute which will emotionally destroy you because you will see the chart moving in every direction because you don't have the long-term view of the 4 hour or the 1 hour. The 4 hour trade that we took here was from a 4 hour order block that I marked through the daily time frame. I looked at the 1 hour and shortened the time and the zone just to mark my level. I put a sell limit there and my stop loss was just above the order block just because if the market comes and tries to sweep liquidity, I still have a room for buffer where market will give me respect and still follow my plan and not take me out of the position. So I waited for a long time, but this trade gave me a very good reward ratio. Um, I see a lot of traders when they sit around and they see the market just moving against their direction and they don't really respect their setup. Let's see this trade if a beginner or amateur trader were sitting and taking the same trade, they would see like that the trade came in their zone and waited for a long time and almost hit their stop loss, and they would panic and cut the trade or move their stop loss even higher. That is the most number one bad thing to do as a trader because you have to trust your setup. If I was not emotionally stable, I would be taking my trade and looking at it as a loss and being like, okay, I'm just gonna get out now. I'm not gonna wait for my TP because as you see in this trade, it came all the way almost hitting my stop loss, and then it went almost like 400 or 500 pips down, even more than that. But I took like at least 400 pips. But this trade shows that a lot of people will not hold the drawdown phase because they will see the numbers going higher for their account, and they will see like they will make this much but lose this much. They will hold their stop loss more than their TP. Rule number 3 is establishing absolute capital autonomy. A high status trader never lets their mood, their identity, or their daily emotional state be dictated by outside validation or a single position on a screen. If you are entirely dependent on constant feedback from an asset just to feel secure, you are not trading. You are gambling with your peace of mind. This trade, a lot of people will see this trade and they will say that he made a lot of money. But the thing is this, in this trade, I had a proper risk management, which a lot of traders nowadays don't have that. If you see a lot of traders, they will risk more than what they have. And if the trade goes against their position, it will wash their account or put them in a drawdown, which they could never recover from. In my beginning years, I learned this as well, that there's no perfect strategy, there's no perfect positions. It is always to manage your risk and manage your capital. If you don't have the capital, you will never have a trade or you will never be able to trade. So, the number one thing I will say for traders is that always have a safe capital and risk safe on a trade. If this trade had a stop loss for 200 pips, I made sure I put less lots and managed my risk as properly so the next time I still could make the money back if this trade goes against me. So when you see traders risking more, that means they have more capital. You have to realize that when you walk away from a setup that didn't respect your boundaries, you weren't losing. You were preserving your values. But this was my trade for this week, and this is my trade recap. Make sure you like the video and subscribe to the channel. Thank you.